Hey guys, welcome to our financial future. This is a channel designed to build a community of investors so we can all grow to our financial freedom. In this video, I'm going to go over some beginner financials of the income statement, balance sheet, and cash flow statement. So let's get into this. Being able to read a company's financial statements is very important when it comes to putting them on your watch list. You want to be able to read financial statements so that when you know you're going to do research, you are looking into a good company already. So let's head over to my computer and check it out.
Hey guys, so the first thing we're going to want to do is Google Yahoo Finance. And we're going to click here and it's going to bring us to this page, and I'm going to look for a company called Enphase Energy. This will bring us to the main page here, where it gives you a little bit of financial data or just stats about the company. And then we're going to want to click financials right here. So it brings us to this page of the income statement, balance sheet, and cash flow statement. And you can see up here in the left-hand corner, it says all numbers in thousands. So that means that this number right here is 729 million, not 729,000. So we're going to start here with total revenue. Total revenue is how much the company is able to bring in from their total sales of their services and products. When we're looking at total revenue, we want to see that this number is consistently growing if they are a growth company. Now, a growth company will generally have ups and downs. It won't be a straight line up, but you can see here that they made 322 million, then 286,000, and then 624 million. So their revenue actually doubled over time. Now, if this was a blue chip company or a dividend payer, these numbers would be probably in the billions, but there wouldn't be as much growth in between the numbers. So that represents a more stable company, and that's what you can look for. The next line down is cost of revenue. Cost of revenue is how much it takes to make the product, which explains cost of revenue. We want to see this number declining while revenue is going up. Gross profit is just the difference between these two numbers. So 624 minus 403 is 221. And this is how much they're able to bring in after the cost of the revenue. And this is not including taxes or other operating expenses, which is what we're going to get into next. So research and development is how much it cost the company to do some innovation or develop their products so they can become competitive and relevant in their industry. It might not matter how much they spend on it, because you want a company to be always advancing their products and becoming relevant. It's just a guideline to know what that is and to tell, oh, you mean they spent 50 million this year but only 33 million this year. It depends on the story of the company. Selling and general administration, also known as SG&A. This is what it takes to sell products, or the back end. Like the administration part would be like having lawyers, or the selling part would be the cost of sales offices and stuff like that. And then total expenses is just all that added up. The next line down is operating income or loss. And this just shows how much it costs to operate. Interest expense is how much interest they're going to pay on loans or something like that to deal with operating. Income before tax is how much money they're going to make before they're taxed. And then net income is the important number, because this is essentially profit. What it is taking your gross profit minusing your operating income or losses, and you're getting your number down here. So it's all of this to get you at this last number, which net income is. You want to see that number growing over time, or the company won't survive and they'll have to spend more cash and take on more debt to last longer. Now the balance sheet. So an asset is simply something the company owns that's worth money. Current assets mean that asset can be turned into cash in the next 12 months. So we have cash and cash equivalents, and cash equivalents can be something like a bank account or a bond that is going to expire in the next 90 days. So you can see here that their cash is consistently growing and it's added up over time. Net receivables is a product or service that they've provided, but a company hasn't paid for it yet. So the company has that money, but it hasn't been paid for yet. And this is generally a contract that has to deal with the company and the supplier. Inventory is products or materials that the company has, and it's giving it a dollar value to what they have in their inventory. And this is total current assets, is just the total assets they have that they can turn to cash in the next 12 months. Further along the lines, we have non-current assets, and that is things that can't be turned into cash in the next 12 months. So after a year, that's the way you want to look at it. Anything after a year. So property, plant, and equipment is things like land and machinery, and it's giving it a dollar value to that. So gross property, plant, and equipment, 91 million here. And then accumulated depreciation is like your car, for example. If you left your car sitting there, it's going to depreciate in value. So it's showing you that over time that these things are going to become less valuable and need to get replaced. And then it gives you the total amount of what they could sell all that stuff for after depreciation has been taken off, that they could turn into cash in the next year. Goodwill is if company A went out and bought company B, and let's say company A paid $10 million, company B was only actually worth $8 million. There's things that company B has that can't actually be really evaluated in a cash sort of way. And this can be stuff like, let's say McDonald's. If you bought McDonald's and that was the $8 million company, coming with McDonald's is their logo and their customers. So this is how they put a dollar amount on those things. And it's the gap between the 10 and the 8. So it would be $2 million worth of goodwill because of the customers and the logo and other stuff like that. Intangible assets are things like logos and patents. That intangible just means they're not physical. And other long-term assets will be in an annual report that you'll have to dive deeper. And then it gives you total assets of all the stuff the company owns that can be turned into cash. Next thing we have liabilities. And a liability is something the company has but owes money on. So current debt of 2 million, meaning they have debt that they have to pay off in the next 12 months of 2 million. And this is why it's important for a company to have cash so that they can pay this off. Accounts payable is them owing money to a company that is in a contract that they will have to pay off in the next 12 months. Accrued liabilities means a company has provided them with a service which the invoices have not been received, so it's money that they're going to owe. Deferred revenues can be something like taxes, where this is going to have to get paid off in the next 12 months. And then this gives you your total current liabilities. So the stuff that you're going to have to pay off in the next 12 months. Long-term debt is how much money they're going to owe over a longer period of time. This is in the annual report, and you'll have to go see what this is. You want to have a company that has a cash position that is usually double of what their long-term debt is, or at least bigger than their long-term debt, because a company with long-term debt and doesn't have enough cash to pay it off won't survive for long. Retained earnings has to deal with profit or net income. And if a company doesn't retain their profits, this number keeps adding up. And the only way you can get this number lower is if you make profit and retain it and do something with it. So you want a company that has positive retained earnings and can keep retaining earnings, but a growth company usually has negative retained earnings because they're not profitable. And then total stockholders' equity is how much money the shareholders have put into this company. And where this number comes from is if you took total liabilities and subtracted it from total assets, you get total stockholders' equity. And then at the bottom here, it just adds everything together: total assets, total liabilities, and stockholders' equity. So now onto the cash flow statement. There's not too much on the cash flow statement, but what the cash flow statement is it's telling you cash going out and cash coming in. So inflow of cash flow, outflow of cash flow. And net income, we've gone over. Depreciation, it's kind of all the same stuff. It's just showing the money that's going out in depreciation. But the important number here, or important numbers, are acquisitions, knowing if the company is spending money to acquire other companies, and debt repayment, which shows if they are paying off that debt that they owe, which is an important number, because if your cash position is still good and they're paying off debt, then you're knowing that company is doing good things and being able to manage their cash. Then it just shows how much cash they have in that period at the beginning and the end. CapEx is for things like maintaining property, plant, or equipment, or investing in new technology or growth. And then free cash flow is what they are able to keep in their pockets at the end as cash after everything. And this is like showing you pretty much what has happened from when they sell a product, it goes out to the stores and comes back to them. That's free cash flow that they're able to generate. So if they were able to put a hammer on the shelf for $3 and only make it for $1, that $2 difference that comes back to them after the whole process of selling it is free cash flow.
Guys, thanks so much for watching my videos. If you found this useful, hit the like button. If you're new here, hit the subscribe button, and I'll see you in the next one.